And once again, please keep your eyes and ears open. This should be a really exciting panel. And I'll ask you some questions after we're done. And also, you should know we will be heading into lunch. So, stay put for this exciting panel discussion. And then we'll take a couple of questions and we'll head out to lunch. All right, we have everybody on stage. Welcome. Take it away.
Is this on? Hello, can you hear me? Oh, there we go. Perfect. Thank you very much, and good afternoon, everybody. My name's Anthony William Catt, and I will be moderating this afternoon's session on the relentless need for exits and capital, a hot topic we're seeing in the ecosystem. And I'm going to give my fellow panelists an opportunity to quickly introduce themselves, but specifically what angle they come into the ecosystem for capital mobilization and exits. But before we do, just to kind of set the scene for what we want to cover today, the purpose of the session is to discuss the all-important African VC journey to exits and ultimately attracting new capital into African tech markets, whether that be an IPO, an M&A activity. The purpose of this session is we really want to highlight the need for exits and the steps the ecosystem can take to enable them and ultimately grow. A couple stats I want to kind of rattle off for scene setting is in Brighter's latest annual investment report, they said over the last decade we've had about 20 billion in capital allocated into venture startups, but the global average at the moment is about 10 to 1 for venture capital exits. Yet on the African continent right now, the average is about 20 to 1. So we're off that global average. And then within that, when we talk about exits and IPO being a big topic today, only 2% of all exits on the continent in the last 8 years have come from IPOs. So the real question is, are there not enough exitable opportunities on the continent, or have we not got a system that better enables and brings the right capital in to get those exits? So we're going to dive into that in 3 different topics, but before we do, we'll go from Ariel on my left to right. If you could just quickly introduce yourself and specifically say what your role is in around capital mobilization and exits. Thank you.
Thank you very much. Hopefully my mic is on. Yep, Ariel. My name is Ariel. I'm a partner at a law firm called Goodwin Proctor. I lead our equity capital markets and public company practice for EMEA. We're a life cycle firm, so we act for startups all the way to later stage. I tend to focus on the later stage private capital raising and exit via IPO, and have a particular focus on tech and healthcare companies looking to list in London or New York.
Hello everybody, Simon Olsen. I'm a partner at Deloitte and I lead our Africa IPO team. That means I work with businesses across the continent listing either on the local exchanges or on international exchanges like London and New York.
Hello everyone, I'm Tracey. I'm from the UK government's Department for Business and Trade. Hopefully that signifies how important we think about this. I focus a lot around working with UK companies that are looking to invest in Africa and provide services, and that's why I've pretty much joined with this great group here today, so look forward to talking more. Thanks.
Hi everyone, my name is Ajayi. As my colleague said, responsible for primary markets for Middle East and Africa at the London Stock Exchange. Hopefully we'll be telling you a little bit more about why this space is important to us as an exchange, and London's relevance in respect to developing local capital markets as well as communities, as well as the tech sector generally.
Fantastic. Ariel, Simon, Tracey, and Abby, thank you for joining. And what I'm quite excited about this panel today is you'll see there, or hear there hasn't been any investors as such from the venture capital space or any founders on this stage. So we're hearing the other side of the perspective, the market makers, the exit enablers, and I think we're going to have a really interesting perspective. Just though, as a pulse check into the audience, by show of hands, if you're a founder or you're an investor working with founders, have you engaged in any consultation or advice on what exits might look like for your company or your portfolio companies? By show of hands. Okay, we've got a good few show of hands, so this should be a relevant conversation. Now, I've had the opportunity to speak with everybody on the panel in prior conversations, and we were in Cape Town in November, December for Superturn and other activities, and the exit topic came up several times in the sessions we were in. And the kind of core three areas I want to try and cover in the next 45 minutes, and I'm going to come to questions from you in the audience, so please do think about what you might want to ask our panelists, is starting off looking at exit options and the considerations for that. Then look at what are the value chain considerations for exit. So what do we need to do to enable these markets? And then finally, ultimately, what does that do to help us attract new capital into the markets? So diving right in, Tracey, I'm going to start with you. Talking about the exit landscape, I mean, compared to other emerging markets, kind of what are the most common exit options you're seeing for tech startups in Africa? And is there anything unique from your perspective or the British government's perspective that we should be looking at?
So the fun thing, or the not so fun thing, is that Africa is just like everywhere else at the moment where we've seen this huge drop in funding. That's not a surprise, everyone knows about that. But I think the key thing that we're starting to see is if we don't start to equate exits to capital raising, we're just not going to raise capital. And I always get slightly disheartened that we're not packed every single chair in this room today, because everybody's going to need more funding at some stage. And I think where we've looked at a couple of things is we've seen, and we only talk to private sector, so as much as I represent the government and we're in the interest of supporting UK companies as well as African companies for growth and for profits, we are actually seeing two distinct trends. We're seeing GPs or fund managers that have really gotten on with what they know is their day job and they've perpetually been focused on exits. And then we're seeing a new trend where there's a focus on now we need exit managers, much like a CRO or a CFO. I would probably think that this needs to become the new normal. I think that's the trend we're seeing. But the biggest thing that I'm still sensing is disappointing is that, and I'll come to this around the data, is that we're just not seeing enough conversation around exits. And there's a couple of players I'll call out later, but I think the biggest thing we see is that actually we talk about the money going in, we talk about the volume of capital raised, but we're not talking about the exits, which we know are not happening. But more importantly, we're not talking about when exits do happen, why they happen. What was the motivation? What is the reason? How does inefficiency play out through those exits? So that's a combination of the conversations that we've been seeing, particularly around the African market. Thanks.
Fantastic. And I guess we talk about exits, and with that point, we have got an IPO kind of centric panel here in some of the conversations we've been having and the work we're doing. Only 2% of exits on the continent have come from IPOs. And I know, having had conversations with founders and investors, an IPO on the continent just seems like almost a far-flung concept right now than a tangible thing we can do. Abby, obviously from the London Stock Exchange Group, this is your very much your ballpark. So just for our audience, could you maybe give us a bit of a sense of what an IPO is in terms of what are the different options for IPOs? Because obviously people think of the big multi-billion-dollar unicorns IPOing, but there is a range and there is accessibility at different levels. So could you just kind of set the scene a little bit around what type of IPOs are accessible?
Thank you. So I think to take up from where Tracey left off, people celebrate, oh, I've been able to raise $50 million for my company, and I'm sort of scaling for the next stage of growth. Forgetting that capital and the investors that put that money in will need to realize an exit sooner rather than later at some point. And that capital needs to be recycled. More and more, the conversations I have with VCs and investors and private equity guys going into tech startups to say, look, there needs to be an alignment of that journey between yourself and the founder. Like, you're taking my money now, I'm going to need an exit at this stage. I'm going to need us to work together to actually navigate to a dual track, either a strategic sale or an IPO. And that conversation needs to happen on day one. And if you're thinking about that on day one, then that means that you need to start to build yourself into a public company, which means you need to be ready to democratize your ownership. You need to welcome new investors in to join you on the journey as you scale. What I'm most excited about London is the fact that we are the most international exchange in the world, bar none. People don't know this, but outside of Africa, London represents the largest aggregation of international companies anywhere else. I'm sorry, largest aggregation of African companies anywhere else. There's 115 African companies listed in London, market cap of nearly $100 billion and growing. And what we've been able to do that in the spirit of partnership with other local exchanges and local markets. So 50 of those 115 companies that are listed in London are also listed in local markets. And we are at least a platform that welcomes both small, medium, and large. And we have two different sort of platforms for you as either a tech startup or a budding unicorn to come to the exchange. So there's what you call the AIM, which is the alternative investment market, which supports growth companies like yourself. And you don't need to be a 50, 100 billion dollar company in order for you to come to London. Last year, we listed companies as little as a $20 million market cap on AIM. In the same token, we also listed a $1 billion company on the standard markets. And what London sort of represents gives you an opportunity, one, to also tap what is a very active and government-mandated capital AUM, which is growing and allows you to be able to tap that if you do decide to come. We are reorganizing, and I say reorganizing to make sure that we are match fit. In the more than 20 years that I've been in the market, we're going through what is perhaps the biggest reform that we've seen in terms of capital markets to ensure that London retains its relevance and importance in attracting international companies on its platform. So what you'd expect later this year, where we've gone through what you're calling primary market effectiveness review to make sure that companies like yourself have a better experience, and it makes it easier. So when you say easier, not reducing the governance or rigor, but ensuring that you are better able to access what is a world-leading platform, an opportunity for you to get yourself visible and actually attract the capital that you require for your next stage of growth.
Perfect. Thank you. And I think the important part there is the alternate exchanges and that range you said from small to big to large. And Ariel, I'll come to you later on another section around the profile of what those companies look like within those categories. But what I want to say is if we've got the market maker, Ajayi, on the stock exchange, Tracey very much the convener, connector and glue to putting things together. Yourself and Simon are very much in that kind of enablement space and taking founders and investors through that journey. Similar questions for both of you, but I'll start with Ariel. Around challenges and opportunities, what are the biggest challenges to successful exits within the continent? You know, is it liquidity, valuations, infrastructure? And conversely, within those challenges, do you see any unique opportunities for the continent?
So I think some of the challenges in the past have certainly been the profile of investor who's been interested in African companies, and that's very much changing. And I think the focus on tech in particular is a real opportunity, and I'll speak a bit more about that in a second, because that I think tech has is a real opportunity for that to be a leveling of the playing field, actually, and in many ways for African companies and founders and investors to leapfrog and access and really close that valuation gap that does exist a little bit, and a discount that unfortunately does exist. I think in the past as well, challenges that we've seen have been around governance. Unfortunately, there's just a perception that internal governance and risk management frameworks within African companies is maybe less robust. And I think there's going to be extra work, and I work a lot with companies 18 to 24 months out who are considering exits, just to make sure that those policies and procedures are put in place well in advance, so there's a nice runway to demonstrate good governance, which helps achieve good valuations regardless of whatever type of exit it is, be it an IPO or an M&A. And I think something that, just to tack on to what Ajayi was talking about in terms of profile, I think we've probably in the past had a perception that to IPO, you know, New York is the only option, which isn't. But, you know, happy to, and we'll come to it, I think, to talk about some of the differences. And I'm agnostic in terms of I can take a company anywhere, but there's some real differences between listing on a big in New York, where you do need to be quite big, but also in London, where there's more of a range and a proper growth market, where you can be a bit smaller and use that as an entry point, an earlier entry point into the public markets than NASDAQ currently is, for example. So I'll say more on that a bit later. But I guess just two opportunities, I would say, because I would always like to look at things in a positive light. But I really think the macroeconomic environment is challenging for everyone and across multiple jurisdictions. But I think also that presents a unique opportunity for the continent. I think people at the moment recognize that what's different, and certainly seeing it on the advisor side, and I advise a lot on investment banks as well, so I hear this on the street, is we can't go through another year of waiting for deal activity. So there really is a perceptive itch to get deals done and a real interest to actually look maybe further afield or in places where, maybe not the traditional hunting grounds for good equity stories. And I think that's a real opportunity for companies on the continent. I also think the sector for tech in particular is a great opportunity, because whilst founders may be trying to solve specific challenges that are applicable in Africa, the structure within the tech is something that is well understood. SaaS is well understood by the international investor. Payments is well understood as a model within fintech. And so that, I think, can be really critical in helping close the valuation gap and make exits, greater opportunity for exits for African companies and IPOs in particular.
Yeah, I just wanted to echo a point that if you're not already talking to the likes of Ariel and Simon on my right, you should be, because one of the strongest pieces of feedback which we've picked up interviewing LPs is they're not in a rush to invest like they were. Deployment's taking longer. And the one thing that they're definitely doing is they're doing far more rigorous, detailed due diligence. And they are expecting a greater focus on governance. So if ever there has been an opportunity for people to get their governance right, it's now, and it's more than an opportunity, it's a big imperative.
Excellent. I think that I'm going to use you, Simon, now to kind of take us. We've talked about exit options and some of the considerations, and my kind of question is around that, but it's also going to lead us into the value chain considerations, that end-to-end journey. So this is kind of a two-part question for you, but you'll blend it nicely. We were at the Nairobi Security Exchange this morning having this conversation, and John Azar from Enza Capital, he made it very clear we've had a hard reset in the last 18 months, and there's a complete reconsideration for how the venture capital and the tech startup space in Africa and globally has to act. And we're back to kind of basics, unit economics, profitability in our businesses, which actually, when we've had the conversations about IPO readiness, are the fundamentals to be a IPO quality company. So my two parts are really, you work across the continent around IPO readiness, and you've done a lot of great workshops helping promote and help people understand that process. So from your side, the two-part is, what are some of the biggest pitfalls you've seen in companies considering IPOs on the continent? But equally then as well, what are the considerations for founders who might be in the room right now who feel very far away from an IPO, but are things they fundamentally need to get right early on to best set them up for an IPO or any other form of exit?
Yeah, thank you. I think one of the things I'd encourage people to think on early, and this does come to both the pluses and the pitfalls, is you've got to get in your head, what is going to be your equity story? So if you picture yourself sat in front of potential equity investors, what is it that you're going to be telling them? Why would they want to invest in your business? And the earlier you can understand that, and particularly think of it through the lens of an equity investor, which may well be different to the lens of a private investor, the better. So you want to look at, what is it that similar listed businesses to me look like internationally? What KPIs do they use? What is it that interests equity investors? Take free advice, speak to people like me, Ariel, Abby, investment bankers, to get a feel for what it is you're going to want. And the reason you do that early is you start then thinking through, how am I going to talk to investors, and what data and information should I be recording as I go along in my business, so that in 3 years' time, say when I IPO, I've got a 3-year track history and I can talk to it very accurately and knowledgeable. I think one of the biggest pitfalls we see both on the continent and more broadly is companies, frankly, that just don't have their house in order and haven't really thought through, why would an equity institutional investor buy into my business? The other thing I'd say in particular on that for African businesses is, be prepared to explain your business in the context of the countries in which it operates to equity investors. So if we look at London, for example, as Abby said, there's 115 listed companies based in Africa already on the exchange. So there's a reasonable understanding of the continent. But nonetheless, you will have to explain to investors how your business fits into the economies it's in, to the political situations it's in, to the currencies it's in, and probably do that a little more than maybe a European business would have to do. So I think, again, get your house in order and get your story very straight on all of those.
Thank you, Simon. I think the other thing to just add to that is what London allows you to do is it represents the most diverse capital base that you find anywhere else. Because it's also a capital base that understands international stories, has an aggregation of research writing platforms that sell international stories. And in addition, also understands the bits around exits. London has an affinity for secondary sales. I mean, in the last year, you find that, you know what, more than 45% of the offerings that we saw last year was around sort of secondary exits. So for investors in here wondering, like, how do I get 100% exit? So there's a bit of time for you. You can sell 40% down. There was a company some of you might know called Catt Payments, like one of the largest IPOs we saw last year in London. Largely venture-backed or private equity-backed. 40% of its offering was secondary, and 100% of its offering was secondary. So essentially, it was a free float of 40% post that offering. And it's one where you can also allow the company to grow into its value, not necessarily get the pop that you're looking for on day one. Because my CEO always says something that IPOs are not just for Christmas. It's for once you come to that market, allow you to continue to come back, to raise the capital that you require to want to finance the growth that you need. And so long as, number one, there are two things that we always tell you when you come to the market. Two fundamental rules. Don't miss your numbers and don't miss your numbers. If you do that, investors will continue to reward you by supporting you on your journey. Last year, for example, we only had about 22 odd IPOs, raising just under $1 billion. But there was another $21 billion raised from 251 follow-on offerings of the 1,900 that were listed on the market, which means even in very muted markets, that the markets was very supportive to support companies that wanted to continue to execute their business plan even in very difficult markets.
I mean, we go again at that point that the IPO, you said, it's not just for Christmas, it's for life, but it's a way to continually generate more capital for your business, but also it's a vehicle to get more capital into the ecosystem. I'm not ignoring this side, Tracey. I'm going to come to you in a second, but I'm just going to stay over on the left side and go to Ariel. Obviously, when we come to an IPO and this form of exit, we're not just talking anymore about your venture capital fund managers and the founders of businesses. Goodwin here, Deloitte here, you are the enablers. So could you just talk us through who are the key stakeholders that are involved in that process, those here in the room, but also might not be here in the room?
So of course, as a lawyer, I have to say that getting good legal advice has to be high on the priority list. And actually, not doing that early enough, it could be more expensive later on. So really think about that, I think, and get good advice. And I think if you could work with a firm who can see you through, so help you on private capital raising as well as an IPO who understands your business and can really help you, do the exercise that Simon rightly points out, and helping work together with your financial advisors and accountants, looking at your equity story and how that features on your board agendas, how that gets taken back into strategic decision making, so that actually you're building that path to achieving the equity story. Clearly, as well, thinking about your financials, and I'll let Simon think about that. The sort of structure they should take, the standard they should be prepared to, is possibly one of the longest and holes in the tent, I think, when it comes to the process of getting that right and thinking about that early is really important. And I also think speaking to investment bankers is actually really important as well, having those early conversations. I think they're increasingly willing to speak to particularly growth companies where they know that trajectory, that path could be quite quick, and that growth trajectory could be quite quick. They're willing to speak to companies who are a couple of years out and establish that relationship with them, because sometimes it takes a couple of touch points for them to understand your business in the way Simon's also outlined, and then help to sell your business and help find investors who are willing to come in, say, on an IPO. And I guess just to add a little bit, in addition to thinking about your equity story, but from a legal perspective, really think about and work with your advisor team, getting the good in-house governance in place. Since the collapse of Silicon Valley Bank, tech investors in particular are very focused on, more so on diligence. We're seeing harder diligence, sort of more later stage diligence actually happening earlier in the funding, in earlier funding rounds as well. So be prepared for that, be prepared for more scrutiny, and again, working with your advisors to help you leverage, say, a data room from your latest funding round, for example, or to keep that going, helping putting in place good governance frameworks, horizon scanning for potential litigation or disputes you have, because once word gets out that you're up for sale or you're thinking of an IPO, those disputes get a lot more expensive and difficult to settle. So really working with your advisor team to get you as ready as possible before you actually kick off the process will make it a lot more smooth, but also is relevant. I think you'll be a better governed business, and that has its own operational efficiencies, but equally, regardless of whatever exit path you do choose, be it M&A or IPO, a lot of that work won't be wasted.
Perfect. And I would say for those in the room that want some of that advice, maybe grab one or two people on the stage as they get off, because they're busy people traveling around the world. But yes, so the conversing, let's look at this side. We've got the people here. So Abby, what about the infrastructure around exits? What needs to be done more? Or is it availability of talent, regulatory reforms, investor education? What more needs to be done to fundamentally build that infrastructure?
Thank you. I think one thing that would be remiss of me not to mention is that, once you answer the question, why should I IPO? I think one thing which I continue to encourage most of the companies that we speak to, that for those who have the ambition, you should definitely consider listing in your local market as well, because then you build that soft power in the local market, as well as also ensure that you give the customers who've allowed you to actually achieve product market fit to participate in your growth. That's one. Two, and then because companies finance companies, and through your success, you inspire other companies to do the same. In addition, if you've got global ambitions or you've also got Pan-African ambitions, then of course you should also think about London, because what London does is London gives you an ability to touch a foreign investor base that may want to play in your domestic market, but I also thinking, look, I want to do it through internationally, because London is essentially, in my view, an extended shopping window for investors to look at domestic markets. I was saying earlier that about 50% of the companies that are listed in London from Africa are also listed in their domestic markets, which means that the conversation that I'm pushing is around partnerships and a connectivity of markets. So you're being incubated here in Kenya and you're looking to scale, then you can list in Nairobi Stock Exchange and also think about London. Because there's the need to balance the burden of outcomes as well as needs. You need to be in a local market to get the soft power to be able to attract the local talent and give them equity options as you see fit to be able to attract talent. But you also need to raise capital and be able to come to another exchange that will help you drive future growth. As an exchange, we pride ourselves that the big focus for us is around converging 3 Cs, which is one, capital for users and providers. C, converging the second C, which is conversations around how to bring the companies as well as investors together so that companies don't prioritize profits over people. And then communities like this, the tech sectors, Africa Tech, ensuring that one, you're bringing that ecosystem to the work in a way that one, the economy, which is the big thing, is being financed through companies like this. As Africans, one thing which I tell this company is that our entrepreneurship is not necessarily about purpose. It's more around survival. And we need to start to channel that entrepreneurship into purpose so we can actually build something of scale in markets and allow our IP to travel than what we currently see. So you're a small business or a nice business that's incubated in, say, well, I'm saying Kenya because we're here now, incubated in Kenya. You've achieved product market fit, you're scaling, you've got $1 million. Why are you not finding clever ways to actually allow that IP to travel into new markets without necessarily spending capital? So you build the business here and collaborate across more markets so that when it's of scale in 5, 6, 7 years, then you're looking to exit something much larger than what you currently have. There's also the conversation about roll-ups where you have similar businesses operating profitably in different markets. What's that conversation allowing them to come together to actually build something of scale that can get access to bigger financing and more businesses can be financed through that? There's a lot of conversation that needs to continue to take place in order to change the mindset. And I think when you say the infrastructure, it's more around partnerships. And I'm very happy to say that we built connectivity in South Africa between London as well as South Africa, so you can list effectively two companies on both exchanges. We've done the same thing with Nigeria, and the plumbing is done. We're working with the Nairobi Stock Exchange to do the same thing, and we're doing the same thing in a few other markets. So yes, that infrastructure is being built, and we're driving that to ensure that we have that connectivity and fungibility of markets.
So it sounds like it's human-centered collaboration is what we're talking about, and we're flying the flag, obviously, for the London Stock Exchange, but ultimately as well, it's working with the exchanges across the continent. And actually, it tees up perfectly. Tracey, the Department of Business and Trade at the UK government, you're the reason we're ultimately all here today. You've been convening ourselves with investors and founders across the continent and in London to look at how we ultimately collaborate. So to that word of collaboration, beyond kind of somebody getting to the point with saying, I've got my company, we're looking to exit, what needs to happen in collaboration with the ecosystem to drive more of that?
It's a big question, Anthony, but I'd say the one thing, I mean, first of all, a lot of people get really surprised when they see government on a stage like this, and I would say to you that it's actually in our interest that everybody succeeds, so that's pretty much why we're here. But the collaboration actually, a lot of people also assume government's always affiliated to policy. Policy is important, it has a place, but it's what's driving activity. It's business, it's private sector. So the final part of that is really looking at getting into the weeds. Very often we look at conversations around IP, we look at, and I had a couple of founders pin me down around the difficulties that the FCA gives when moving to London. We need to get into the weeds. We have to be very specific about what we want to talk about. There's too much generalization around issues and, sort of trying to synthesize stuff very quickly and say, oh, it doesn't work. So I feel that collaboration is really about getting into the detail. We've always taken a very supply of capital-led point of view because ultimately investment is what drives the City of London. It's what drives a lot of the activity we see here, and it's what mobilizes all these amazing service providers, advisors, and market makers. But I think the final point that I'd say in relation to all of this is that actually we talk to everybody, and that collaboration has to be universal across the value chain. We're going to be moving away from doing more event platforms as we have been running a series of 6 campaigns over 2023. And we're going to shift to a working group model. We found out who most of the players are who align views. We now need to get more research. We need to get data. We need to work on the narrative. And actually, that's our role. So all of what I've described before is really going to hopefully come to some shape or form in the form of a working group.
So I think that brings us on nicely then to kind of my final section, which is really around how we attract new capital into the markets. Right now, we know that funding is scarce. We've seen a massive drop-off in investments made on 2023 to 2022. We know we're down in Q1. Lots of funds are taking longer to raise. So an IPO might seem like far away, but actually it is a capital mobilization exercise and pumps more capital into the markets. So a couple questions on that, and then we're going to come to the audience for a few questions. So please do think about those questions you might want to ask collectively or individually to our panelists. I'm going to start with Abby. LP confidence. It's something people have said we've seen a retreat from the African tech ecosystem. So what more needs to be done to convince LPs, private equity firms and other capital allocators of the viability of investing in African tech startups? Track record assessment exits, data-driven insights, risk mitigation strategies. What do you think are the key things we need to be doing right now as an ecosystem to be bringing LPs in the market and de-risking that and creating more of an opportunity?
So just on the point around converging communities, and I'm sort of a part of a few working groups around converging working groups around governance, to fix governance. It's called the Digital Collective for Africa, to ensure that one, tech startups that are coming into as one on day one, thinking about how the governance should be, to make sure that the due diligence that they're providing and the information they're providing around due diligence is correct and it's in the right form. So on stage one, we're already sort of going through to the early stage investment phase. Secondly, there's now the more matured companies, so around sort of Series A and Series B. And what we're trying to do is there's something called flows, which is funding liquidity options for African tech, which is another sort of working group helping in this segment. What London has done is we've set up a strategy called Funding Continuum, essentially addressing these three different areas of company's evolution. So we've invested in a company called Flow, FLOWW. You can look it up, to ensure that companies around the Series A and Series B have a platform to go to raise additional capital. So essentially to ensure that companies start, stay, and grow in the markets. And then for much more mature companies, essentially that are thinking about the next phase of growth. They're not ready to come to the public markets, but they're also thinking about how do we incentivize our employees to be able to want to stay for longer? How do we attract the best talents? So we've invested or working with regulators, so to speak, to actually develop a platform where companies in their cycle can actually, on a periodic basis, be able to sort of track liquidity. So attract new investors without necessarily one becoming public. So on an intermittent basis, you can continue to sell down. So you don't necessarily have to list. You can attract as many investors as possible. And that platform essentially will give you an opportunity to what you call training wheels before you decide if you want to become a public market, you want to become a public company going forward. And then on the other side, there is all that reform, which we're doing in terms of ensuring that companies have a better experience. We are creating a platform for international companies, essentially, so you can be in your own local market, your own governance structure, and also come and list in London. As I mentioned, that we operate as a platform in the spirit of partnership, combining and working with exchanges in various markets, ensuring that, one, we help to enhance domestic market liquidity and provide an opportunity for companies in local markets to also finance other companies.
So if we then take that as kind of the landscape, Ariel, you obviously look at exits, IPOs, but you actually work across the entire investment value chain around fundraising for startups from the early stage to series and beyond. It goes back to that original scene that Abby had done about what exchanges we have. You've mentioned Flow as well, alternate fundraising vehicles. Talk to us a little bit about what is the actual kind of financial or wider profile of a company that can go and list, aim right up to the main exchange, just so people in the room know, well, actually, what does that exit stage look like in terms of size?
Absolutely. And before I come to that, there was one piece that I just wanted to add on to what I said before, if I could, because the brainwave came after I completed my remarks. But one of the other things that's really important to think about is, and I tend to work with companies a good 18 to 24, maybe even longer, before they even start thinking about an IPO, is actually I'll draft your risk factors first and sort of thinking about it and sit down and think about, okay, well, from an investor perspective, what is going to be considered risky about this business? Overly dominant on one particular currency? Are some of your supply contracts concentrated in one particular supplier? So using what public company investors will be considering in terms of how to value your company or potential risks about the investment, we can work early on, if you get good advisors on board, to help you think about that with enough time to address some of that. So again, you can really close the valuation gap. So apologies for not mentioning that before. But back to the question about the profile. So I think AIM is quite an interesting and a destination that isn't quite as known as it should be. But I think I'll set the context in terms of, I think there's a misperception on the continent, and not just on the continent, but sort of I would put Europe and more broadly, that the US is the sort of the sort of golden land for listings. Actually, to go now to NASDAQ, for example, which was traditionally the sort of growth market in New York, you do need to be a very sizable company. So one of my tech companies, for example, asked me, okay, well, based on our last funding round, Ariel, we were about $1.5 billion in terms of valuation. I said, well, where does that put us on NASDAQ versus London? Well, on London, you're in the FTSE 250 on the main market, and actually you were company 217. So in terms of getting analyst coverage, in terms of being a must-buy stock, getting index inclusion, for example, the benefits of the listing it's not, and I have to say as well, I don't love the word exit for IPO, because actually it's a continuation of your journey. It's just a different way to fund. It's a new chapter, and I think looking at it in that way is the better way. But actually, the whole point of being listed is to be able to go back into the markets and do the follow-ons that Abby talked about. If no one knows you, or you're quite small, then you're less attractive for follow-on offerings. So this company would have been 217. At $1.5 billion, it would have been 719 on NASDAQ, which means the first 500 to 700 companies on NASDAQ are in the multiple billion dollars of valuation. So yes, you need to be a very big company to withstand the scrutiny and the additional corporate governance as well, and ongoing obligations that attach to a US listing. There's quarterly reporting, for example, which is very challenging on the sort of financials front, which gives Simon more work to do and his team to do, which I'm sure he'll happily take. But it is quite a thing for what I see, and a lot of our growth companies struggle with, particularly companies who may not have actually been in existence a couple of years ago, to now move to quarterly reporting. D&O insurance, the liability regime in the US is significantly different than it is in the UK. You're much more likely to get sued. In the US, for example, in 2021, there was 219 or so class action securities lawsuits. Over the course of the last 10 years, there have only been a couple in London. It's just a completely different litigious environment, which means that your insurance for your directors, for example, directors and officers insurance, is about 10 times more expensive in the US than in the UK. So I think people mistakenly think about day one valuation when they think about the IPO, because they get into the exit mindset, and actually I think that's dangerous. But thinking about what life looks like for you as the founder or the issuer of the company post-IPO, but also as the investor who may not be selling out completely at IPO and wants to monetize your investment over a period of time, and therefore tapping back into the markets is really important. AIM, I think, is a really interesting destination that I talk to a lot of African companies about, because you don't need a minimum market cap to come to market. It is a proper growth market. It is the biggest growth market in Europe. And it has the deepest liquidity and access to international investors of any growth market in Europe. It is a real alternative to NASDAQ, which is no longer sort of a small company growth market in the sense it was 10, 15 years ago. It is now quite big growth companies that tend to go to NASDAQ. But it doesn't mean you can't access the public markets. And in fact, I work with a lot of companies who use AIM as an entry point to come first to AIM with the view to maybe stepping up to NASDAQ in the future, or the main market. And Abby spoke about a lot of the listing regime changes that are being implemented in the UK to make the main market more attractive, particularly for growth companies. But on AIM, for example, you don't need a minimum market cap, and the sweet spot is to be around 25 million to 150 million market cap. So you don't have to be a huge company. There's no minimum free float requirement, which is obviously very important, I know, to founders, the founders of you out there, for example, where there is a minimum of 10%, which used to be 25% on the main market. And there's no requirement for a revenue earning track record. It's obviously helpful for your equity story to have a path towards being revenue earning and profitable, but it's not a listing, it's not an eligibility requirement. And in fact, having that trajectory, or having a sort of probably a minimum of 100 million ARR is probably a good place, a sort of benchmark to be thinking about. Investment banks who will talk to you about how attractive you would be to investors will actually look at you even smaller than that, for example, as long as you've got a good path to profitability, a good positive trajectory. And there's been significant changes as well from the government in the UK, what we call the Mansion House reforms, which has now required institutional investors, so pension funds and the rest of it, to have at least 5% of their portfolio invested in unlisted securities, which actually include AIM quoted stocks. So actually, my expectation is that we'll see a significant increase by institutional investors into growth companies, like in particular tech companies. So AIM really should be on the mind of companies. And importantly, and very differently to the US, the ongoing corporate governance and reporting obligations are significantly less burdensome and consequently less expensive. I'm more than happy to take companies to US because I get paid more, but really, and this is something, again, there's a perception that you need to have a Delaware topco, for example. That actually can cost you a lot more money down the line, doing funding rounds and marketing for a company at the moment as a Delaware topco, very early stage, doing a Series A for it at the moment. But their lead investor now for this round is a French investor who doesn't want to hire US lawyers, doesn't want to invest in a Delaware topco, has nothing to do with the US. And now we're looking at trying to collapse the Delaware topco or merge it into a UK one to make it feel closer to a European investor. So really think about and get good advice early on about some of these structuring considerations of what you need in terms of a profile of what you need to look like. You don't need to be a UK company to list on AIM, for example, but thinking about if you are a foreign listed company, Delaware Topcos, I did an equity raise just a few weeks ago for a Delaware Topco that's listed in London, and again, that's very challenging. So really get some good advice about how you're structured and what the profile of a company is. So I guess, well, maybe I'll wrap up just in terms of tips. Look for the international exchange, and I think Abby made the case that London is quite international. The one other distinction I'll raise is companies that list in the US, the investors are that investor base is very US, and they're more accustomed to investing in companies that have US generated revenue. If you do not have plans to generate revenue or to move your C-suite to the US, really think about an exchange outside the US. Don't get caught up on valuations. Think about life post-IPO. That's what, and don't compare apples to oranges when it comes to valuations. And that's where I think, sometimes London and AIM in particular miss out on, having a proper and fair assessment, because actually companies are being compared with, tech companies on NASDAQ, which are much larger, and speak to your advisors early.
Fantastic, very comprehensive, and you summarised it for me, which saves me time. But okay, we've looked at then the different types of exchanges. We've not just got exchanges in model countries. We've got AIM, we've got Flow, we've got other different ways to access that and different vehicles we can take, which actually make it a lot easier to attain an IPO than many might think. Simon, that means we're looking at global markets. So could you kind of briefly talk to us about what the advantages are in terms of accessing new capital? And the summary here of Ariel and Abby is around the platforms and the optionalities, but what does that do to actually stimulate potential new investors into that investment flow?
Yeah, the main thing I'd actually say to companies when you're looking at exchanges is just look at it in your particular circumstances and don't believe the myths you see in the press headlines. Right, so I have a number of people who come to me and say, I'm going to list my business on NASDAQ because I'm going to get a better multiple. Why do you think that? Well, because NASDAQ trades at 30 times and the FTSE trades at 20. Okay, well, NASDAQ's full of tech stocks. The FTSE, the bigger ones, are banking and miners. Like, that's why they're different. But if you look at comparable businesses, the valuation is similar. So I would say to businesses, look at who's going to invest in me, where do I want to be based, where am I going to get good listed peers? We talk about the 115 companies from Africa listed in London. The number in the US, 7. Right? Number in Amsterdam, 3. So you look at where you're going to get money from. I think in terms of how to think about which exchange to go on, there's 2 things I would encourage for African business in particular. Consider the local exchange. Look at, am I going to get good local investment? Is there good liquidity from that exchange? Is there pension fund and other money that may well attract me? Also look internationally. Will people want to invest in me internationally through that platform? And where am I going to get my best peer group?
Fantastic. And so, like with the last section, Tracey, you kind of summarised it for collaboration. So my final question before we'll come to the audience for any questions, so please do think about what you might want to ask our panellists. Every conversation I'm in with funders, founders, it always comes back to this idea of the narrative and the story we're telling. So kind of almost bringing everything together that we've talked about over the last 45 minutes or so, what is that story or narrative? What can we be doing better that's truthful and accurate, but is portraying that right story that's going to engage people in what's happening here on the continent and what the opportunity is?
I think before I answer your question, I just want to say the reason why we need to get the narrative right now is this is a very unique time for the UK, as Ariel alluded to. we're going through deregulation. We haven't had deregulation in a really long time. We've got a natural fit where we have a growth potential in Africa, and we have a UK, much like the rest of the world, in the OECD markets, which has a shrinking, aging population. But I'm not going to get investors excited by telling them the African population is growing. They know that already. That's not enough. So the narrative from an investment perspective is incredibly important. And I think the first thing I say to everybody who's either a data provider, collator, report creator, DFIs, can we just stop the focus on fund volumes raised alone? We have to feature the exit conversation, and we have to feature the why, the where to, and we have to feature the conversation around the ecosystem inefficiency. The other great thing, and I love my job because I'm not fundraising and I also don't have capital, so I'm not being pitched to. So people are very honest with me. And the biggest thing that I enjoy talking to founders is actually that when most of them talk to me, their stories are about creating what I call the must-haves and not the nice-to-haves. Their disruption of what they're building is solving problems that generally become so fundamental. Who could have guessed that M-Pesa now is the absolute way in which you transact? That's the kind of story that actually, believe it or not, is not globally synonymously known. And to Simon's earlier point, if you're not telling your African story authentically, honestly, talking about the challenges, the longer trajectory, you're not going to get the empathy, the understanding, and ultimately the investment that you need. So the storytelling has to be a lot more accurate. And then the last one, again, is around the knowledge, the training, and the capacity building. I don't see many, if any, other than I know of the Deloitte masterclass, capacity building programs where are actually offering free advice, teaching, getting people to become comfortable, be it with terminology, be it with process. Legal structuring, that is the biggest. I'm so glad Ariel went through the whole DLC Corp issue, because that's the biggest mistake we see being made, and money's being spent by the time people realize that they've made a mistake. So my challenge really is it's everybody's job to be part of this, but there's some real need for honesty and authenticity to actually try and take that narrative forward.
Yeah, I think one thing I'd add to that is I think there's a myth that an IPO is really difficult. You know, it's so hard that you really don't want to do it. It's going to take forever. It's going to cost a fortune. You know, in practice, yes, it may seem daunting. Yes, there's people using lots of acronyms and language, but it is doable. You know, there's thousands of listed companies in the world. And with the right advice and the right preparation, you can do it quickly, fairly cheaply, and fairly easily. You know, an IPO, for example, may take you 5 or 6 months. A private round takes you 3 months, 4 months now. But the benefit once you're listed, as Abby said, it's not for Christmas. You want to come back for more money, you can do a fundraise in a week once you're listed, because you're already on that platform. You're already a member of the club. So it is actually, it's daunting but doable. And I think don't be scared of it.
And I think it's that basic fundamental understanding of that end-to-end process, and that's what we try to get out of today's session. But obviously, it's a longer conversation than we can have in 45 minutes. We've got about 5 minutes left, so I'm conscious I'd love to come to the audience for any questions. So if you have a question, please just raise your hand, note yourself and your organisation, and then ask away to the panel or a specific panelist. We've got a microphone ready. No microphone? There we go. Fantastic. Just coming down to the lady in the pink top. Familiar face.
This is the lady who hosted you for breakfast in the morning. Good afternoon, everybody. My name is Mbitha Mwema. I'm the Chief Business Officer at the Nairobi Securities Exchange. I have a question, and I also wanted to contribute to this conversation. I think it's quite timely, and I like what is coming out from the panel in terms of collaboration. I think there's an opportunity of looking at the capital markets and positioning it, especially from a government perspective, and saying that we actually have to find a way to finance risky opportunities, because the traditional entities that we had have all come to a good run, but we have the tech industry that is giving us innovative solutions. And I also appreciate the fact that we do want to position in the local markets. So for us in Nairobi, we have the Nairobi Securities Exchange. And for the last 5 years, we've actually been attracting a good chunk of foreign capital. On a typical day, 65% of our turnover is foreign. I think there have been a lot of issues on currency across Africa, leaving South Africa alone. So we did tend to find investors coming here. Some of the innovative things we've done is thinking about structured products. So how can you actually create that fungibility, investing in one market and investing in another? So we continue to work with the LSC. We continue to work with different entities to say, can you consider a cross-listing, but can you then start off in Nairobi? But I think the challenge to our founders is this. our focus is always the conversation of it's so hard to list, should I list, will I succeed, will I not? So we're at the stage where who's going to be the first one to actually get out of the pack? So the conversation then needs to move to the founders to ask them, who are you and where are you at? And how can we work with you? Because we have local capital, I can go and keep convincing them to allocate capital. They want to say, okay, here are the 10 opportunities. Then let's have a conversation that says, why will you not allocate to this? And how can we then be able to facilitate that matching? Thank you so much for the contributions, and I wish you all the best as you continue.
Ethan, thank you for a contribution from the Nairobi Security Exchange and also for your fantastic event this morning on IPOs and exits. Do we have any other comments or questions from the audience? Yes, Bastian, over there.
Bastian, I work for a company called Bamba, where I run it. I had a quick question around the AIM, which seems to be the consensus in terms of like this might be a good idea if you consider listing versus trade sale or P-buy or whatever. On the AIM, you said in London overall there's 115 companies. Can you talk us through maybe an example of an AIM listing that has gone through the various stages and has been successful that comes out of the African context, just to put it into more practical term? We'll all talk about exits, but I haven't really seen those AIM companies out of Africa that have done well. I've seen 2 companies I invested in that tried to list on the AIM, but then pulled back. They didn't do it.
So just to repeat the question was there basically when we talk about going from an AIM to the main exchange, this journey that can take you across listing over several interventions, have we got a tangible example of a company that's gone on to AIM and then it's gone on to the main exchange or had a successful journey in further fundraising? Is that correct, Bastian? Another question.
I think I can point you to a company called Boku. So Boku, it's maybe a 20-year-old fintech or so, and decided to, as it was thinking on its next stage of evolution, decided to start an AIM at a market cap of about less than $100 million. The market cap now, I probably be doing a thumbs up, but it's one that has successfully sort of raised money 5 or 6 times on the market. It's a tech company. Please do look it up. It's not an African company. But there's another African company on the resources side, which, of course, used AIM to raise capital. It's a venture backed by Helios. It was listed in 2014 or 2015. Got acquired by Seplat, which is also another African company. It's, again, created an exit for the funders. There's 2 other companies that and I can tell you that, and if I look on my phone, I'll tell you more recently that I've transitioned from AIM to the main market because, of course, they found that they become quite sizable. And one thing which Ariel also mentioned to you, that's once you're around at $1.5 billion in market cap, you become eligible for FTSE 250. And in layman's terms, that means that you being part of that index allows you to tap what is passive AUM, which they have to invest in you if they want to be as part of that index, in order for them to be part of the index. And that alone in itself gives you a nice base for you to continue to grow. And as you decide to go into the market to raise additional capital, they will always come to back you. I think the reason why we've talked a lot about AIM here is because there you find a lot of tech stocks there, high growth stocks in London. It's a platform that the government has also created what you call VCTs, companies that essentially are mandated by government to invest in this type of opportunities. And you don't necessarily have to be a UK company. So long as you're on that market, you qualify as what you call UK equities. And there's significant tax incentives for investors to continue to back you on that platform. So I mentioned earlier, last year we did at least 2 or 3 IPOs for one company called Fidel. You can look it up. It's market cap of about £28 million or so. And it's an IP and digital company thinking about going global, and wanted to attract talent, wanted to use the acquisition currency to attract companies in its adjacencies, and to also sort of get that London halo effect to be able to grow and of course expand in new markets and get, how to call it, punch above its weight, so to speak. That's what the CEO says.
Perfect. And I know we're about to be played off, so I want to make sure we just wrap this up nicely. My three takeaways from this, and it kind of came to the question from Bastian there about AIM, is actually listing isn't just a singular thing you do. It ranges across different companies and profiles and is a continuous journey for fundraising that we can consider. The second thing is good governance, IPO readiness. This is ultimately all best practice for companies from day one that they should be considering, and investors should be ensuring that their founders are going through. And then finally, there are active working groups and individuals on the continent helping support this. So you as investors and founders have entities and organizations sitting here on the stage and beyond who can support you directly or have working groups going on. And so making sure that you guys, after this conversation, engage with ourselves and others here. Final comment from each person. If someone is in the audience, they're trying to understand how they engage with you. How and why should they engage you? 15 seconds individually. We'll go from Ariel back over to Abby, but why and how can people engage with you?
Just get good advice, put a team together to help you. Prioritize it.
Yeah, I'd echo that, but also make sure you're dealing with people who actually know what they're doing in terms of African businesses coming to the market. You know, a little bit of self-selling. I've done 25 African IPO transactions in the last 5 years. You know, speak to people who actually done it and know how to practically do it.
It's not a binary thing. It's not government or private sector. It's both. So talk to all of us. Thanks.
So as an exchange, we're doing a lot to support the ecosystem. I think if you look on our website, we recently published a guide for entrepreneurs like yourself, a guide for entrepreneurs. So talk you through capital raising, what to think about. It's a nice 17-page, easy read with a lot of case studies and things to inspire you. Of course, once you own that, once you download that app, it will come straight to me if you're from Africa, and it's a nice way for us to start the conversation. And we're not necessarily waiting for companies that are already ready. We want to start to talk to you right now when you're thinking through your business process, your expansion strategy, and new markets, as well as how you want to access capital and what your equity story will look like in the next 5 years.
Fantastic. Ariel, Simon, Tracey, Abby, thank you very much for joining us. Give a round of applause for our panel. Thank you very much.